Our next guest says we are seeing generational returns in the fixed income and credit markets, calling this an amazing time to be a lender with an eye on opportunities in commercial real estate. Joining us here at Post 9 is Marathon Asset Management CEO Bruce Richards. Always a pleasure, Bruce.
Sarah, good to see you.
You came in and you said we had Manic Monday yesterday.
Manic Monday. I mean, it was not only Mother's Day this weekend, but it was time for all the bankruptcy lawyers and companies to get together. And we saw 7 bankruptcies in corporate America on Monday, which is the greatest number of bankruptcies we've seen on a Monday in a dozen years. And so the credit crunch has arrived. You start with like Envision, which is a $10 billion company, where the private equity sponsor put $3.5 billion equity into it, which is now toast. And, creditors will come out, the senior creditors will come out okay owning the company. But there are a lot of these bankruptcies that have happened. And when we look forward, I've been projecting when default rates were less than 1%, that we'd have a cumulative default rate of 10% before this is over. I'm now revising it higher to 12%. So the credit crunch has arrived, and I'm calling it as of today that it's officially here based upon this Manic Monday.
Based on the fact that we've seen the turmoil in regional banks?
Well, regional banks, are adding to that. So it starts with the Fed 500 base point tightening and the cost of funding being inverted. So anyone that borrowed a floating rate, which is a lot of corporate borrowers, when rates were zero and they were attracted to that cheap cost of money, loaded up on debt, and there's just too much debt. There's a lot of restructurings that's going to come as a result. And the back end of this also is a great time to be a lender. But the credit crunch is here. You look at the banks, and the banks themselves, I'm not talking about the big four or maybe the strongest of the super regionals, but I'm talking about the cohort, the KBW, whose debt trades below 80. And that's really the tell. Watch the equity, watch deposits, but don't forget to watch the credit. And when the credit trades at 50, 60 cents on a dollar or lower, it means the banks themselves are having trouble getting financing. So how can they lend when people aren't actually lending to them?
So whose opportunity is that?
So that's an opportunity, I think, for the lending community to step in.
Direct lending.
Because the banks are not going to be in position. Exactly, because the banks are not going to be able to be in position to lend. Think about commercial real estate, for instance. There's $1 trillion of commercial real estate debt coming due in the next 2 years. Banks are 50% of that lending market. Well, the private credit lending market is only $100 billion of real estate debt. So there's a big gap between where banks can lend and where the private debt community has enough debt to lend and what the capital needs is needed by the real estate operators. And so this is all coming to roost as debt maturities come up and as delinquencies start to rise, and we're starting to see that.
So I'm going to guess the loan officer survey did not fully reflect what's happening last week or the week before. And the Fed, this allows them to declare victory for now?
Well, I think, the Fed has raised rates 10 straight times since March 17th of last year. And I'm on the fence here, but I think they're probably done. Are they going to move come June 15th and 16th? Probably no, unless on June 3rd you get a big CPI print. If you do, then they go right back at the next one. But right now, based upon what we're hearing from the Fed governors, I think, and based upon the credit tightness that we're now seeing, I think it's not only prudent to pause, but probably what they're going to do.